Well, good morning, active traders. I'm Ken Calhoun with a special precursor to our Trading Week Ahead broadcast, a new feature called Win with Ken. What a clever title, a 10-minute trading strategy session. This week I'm going to teach you how to set your entries, part 1. And again, I'm a guy who's done as much as 5 million profitably in a single freaking year, so I know how to trade and I'm the real thing. Boom! Let's take a look at a few ideas on how to do this. 3 ideas to how to set your entries the right way. First is always to have a safety buffer above resistance, and I've covered that many times before, so I'm not going to spend a lot of time on that. But the main thing that I want to cover today is I want you to start using the range, the point range of the chart that you're trading and the slope of the line before you get into it to help determine how far away from the obvious resistance area, the previous high, you're going to set your entry trigger. And that's critically important. If something's extremely sharp up, it may well drop right back down again. Similar if it's very sleepy and quiet, it may take forever to go up. So we want something in the middle, kind of 45-degree angle, and we're going to take a look at how to use that data to set your entry. And also have 2 entry prices to test. So ask me questions as well if we have time. As always, all information is for educational use only. I'm not making advice about what to buy, sell, or hold. And by watching this, you agree to not make actual trades. Let us go ahead and get underway with today's broadcast. I hope that y'all are having a happy Saturday. I'm Ken Calhoun. Let's take a look at our entry strategies, our strategic points for how to set entries. And this is the first in an ongoing new series of trading that I want to give to you. Let's start off with an instrument, dust. I'm currently long dust in my Fidelity real money trading account. I bought it earlier. I'm a little bit nervous long though, and you can see why. Yesterday was kind of a bearish cup, so I'll likely collapse the trade and go back to cash if we get under 38. But this topic is how to set entries. So the first step is find charts with big ranges, and this chart has a 27 to 43 trading range, right? So that's 16 points. So yeah, that's correct. That's 16 points from 27 to 43. 37, 43. 16 points. So the range is extremely large. That's one data point. The other is, you look for the chart pattern. We've got an acceleration ramp, a steady uptrend, a gap, continuation up. The question is, where above the current high do you set a long trigger? Again, this is not a trading recommendation, but I've often said using 50 cents above the whole number, nearest whole number high is a good place. But in this case, that would be too soon. And I'll tell you why. With this number of point range, in a three days it's gone 36 to 43, that's a 7-point range. That's a little too close. So how to set your entry? The first thing is the approach is, if you have a large trading range with a lot of volatility, you set your entry further away rather than too close. If you've got a very quiet, sleepy chart that's slowly grinding, you usually want to tighten in your trigger to capture the first breakout. And so look for those relationships in the charts as you trade. So for example, here I would be long somewhere between 43.5 and 44, say 43.70. Remember I said that, and then come back and be amazed at some point in the future. 43.70, yeah, that would have worked. That would be the earliest trigger I'd go long. New traders, that's a safety buffer, again, because we expect the false breakout. You've all been in that situation where it's gone up right above resistance. You don't want to miss the boat, so you get long. Then it goes up a little bit just to get your hopes up. It comes crashing down. You get stopped out, and then it runs up without you. Really pisses me off. So what I learned is make sure that you have an intelligent way to trade with a chart that makes sense. Now here, where would be your long on this? Who can tell me? This is one of the picks that my Swing Scans members got last week. Last week I told them long at 2180. Boom! Flawless victory. He shoots, he scores, the crowd goes wild. How much money could you have made had you been a Swing Scans member and bought my long call at 2180? And I showed the screen cap proof of that. Well, the point is now we can't go back in time unless you've got a TARDIS or a DeLorean or some such. But for those of us who are mere mortals and don't have access to science fiction things, we can't go back in time. We got to trade the right side of the chart. So where would you guys go long? This chart has a nice steady continuous uptrend. A nice classic 45-degree angle breakout. Now, can everybody see that buying 23.8 would probably be a boneheaded mistake because it may run, not that that's a horrible trigger, but it may run just to 24 or so and then stall and drop. So the earliest I would go long, I don't have to wait all the way to 24.5, but earliest would be somewhere right over the 24, maybe 24.20, 24.30. One of the most important concepts that you will learn from me, and this is valid whether you're selling puts, buying calls, doing your credit spreads or debit spreads or iron condors or butterflies for options traders, or you're just trading the underlying, you've got to trade charts with enough theta, enough directional volatility to make sense that's likely to continue after you put on your trade. Okay, that's one of the keys. It doesn't particularly matter if you go long at, say, 24.2 versus 24.3 versus 24.50. That's the less important component of how to set your entries. The more important component is trade the right instruments in the first place with enough underlying directional volatility to make you money when you put on the trade. See, I don't care if I buy 24.25, 24.5, 24.30. I'll take the shot, use a tight stop. If it works out, I'll scale in. If it doesn't, that's what small or break even preferably stops are for. So that's another quick tip on how to set entries, is use charts like this that have good directional volatility. Look at that, a nice monster run. We got a small gap, a big monster day here, and then it ran on up day after day after day. And this has been a good winning alert for my Swing Scans members. This is the type of chart that I like to focus on. Here's one that I'm covering for my small cap scans members. We'll cover that in the main broadcast as well. But how would you set an entry on a cheap chart like this? And by the way, get away from the whole idea, number one, never buy the obvious resistance breakout, because you're trading against sharks like me, and we're in it to take your money, son. We're not in it for charity. We're in it to win it. I'm in it to get paid. I want to make as much money as I can as a trader. So I'm going to do whatever I can to capture money from the market out there, and I want to buy at prices that's likely to attract, like a magnet, a new wave of buyers, not the wave of institutional sellers that sell to the amateurs. So avoid the dumb money approach. The dumb money trigger would be, say, I don't know, just at 330 or 328 or something like that. Obvious resistance sucks. Never buy obvious resistance. You can quote me on that. That's the sucker's play. That's the mark. You're at the poker table. You don't know who the fish is. It's you. You're going to get taken, son. What you want to do is trade at a price point somewhere above here that's likely to attract a wave of new buyers after you buy. Simply buying a new high is a recipe for failure, especially in this mean reversion market environment we've had. So how to set entry triggers. What's our time look like? I've got a couple of minutes left. How to set entry triggers. Minimum 20 or 30 cents above the high on these cheap under $10 stocks if you trade those. Here's another good example of the type that I like to focus a lot of my energy on. We had a mean reversion here. Do you see? Mean reversion, mean meaning the X bar or the average. Just a fancy way of saying a 50% retracement is what we used to call it, but now we call it a mean reversion. We got the small gap, we got the initial directional breakout, we got the pullback to 50%, aka the mean reversion, and then the resumption of the initial breakout trend, and in this case that was up. So we're all the way up to the 21 whole number, which is a resting place for it. I'm going to cover more in an upcoming episode of our Win with Kin series, but I wanted to just, and very quickly, get you up to speed on a few of the things that we want to start looking at with the range and the slope. The last tip here, which I didn't have time to cover, is I want you to use two entry prices to test. So if I buy this guy at, say, this is Hertz, driving off the parking lot nicely, zoom onto the freeway. Hertz Rent-A-Car is renting its way up to new highs. If I buy 21.5, I'll buy again at, say, 23.5, maybe 24, a couple of points up. So always have a position size scale-in entry or an add-on trade entry in the back of your mind. At least you don't have to put in the buy stop order in your brokerage account, but at least have a rough area at which you'll likely enter a second trade if and when the trade proves itself profitable, so you can leverage up in the trade. And that's another tip. So Well, thanks everybody. Appreciate it. Question from TJ: do I enter on odd numbers and sell on even numbers? No. I'll trade at any. I will certainly buy on an odd number like 21. What I do avoid is buying the nines. So if something is up at a $9 price point or something, it may be better to wait on that. But when you see good breakouts that make sense, that have really good directional volatility, or reversals, bullish engulfing patterns, or other breakout patterns, runaway breakouts that are up at new highs, it's usually a good idea to sell into an $8 or $9 value. But no, I trade equally both odd and even numbers. What I don't do is buy a 9, because often it'll slow down. Once it breaks above the decade value like Hertz just did, especially at a 90-day high, it may make sense. So anyway, good point. Thanks to all of you for asking smart questions. So what's the verdict? Thumbs up or thumbs down? Should I do more of these? I know it's kind of quick and fast, but that's how I am. I'm a short attention span kind of guy. I don't like to sit along and drag things out like so many educators do, blah, 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 and then some big sales pitch for some overpriced hoo-ha at the end. I don't play that. That's why I've got 5,400 of you registered. Because I like to treat you guys with the golden rule, the way I'd like to be treated, right? It's just common sense. But should I continue this? I wanted to extend the time, and since I can't do that on the tail end because I got swing scans in 33 minutes, I wanted to move the clock, move the sands of time forward, and start a little bit early, around quarter till, with a nice strategy session with some quick, intelligent, focused, well thought out, based on real money trading experience, wins versus stops, to give you guys the benefit of some very quick technical patterns and trade management tips. Those dovetail, by the way. Your technical trading is only as good as your trade management. And of the two, trade management's a million times more important than your technical analysis skills. So TA is, 10-20% of making it as a trader, but ultimately it's all about the money, and it's all about the trade management. Itty bitty stops, play the field, trade wide, not deep, and then add to the winners and scale out of the stops and make the math work out by using that combination approach with the strongest charts. At least that's how I do it. All right, thanks everybody. Appreciate it. And all these continues. Yes, very good. Do more of these. Good. Do more. Yes. Do more teaching. Thumbs up. Thanks. Appreciate it. Great if I have the time. I'll try and make the time for you guys. You guys are worth it. You've been like the most loyal audience ever. I've been running the GoToWebinar sessions, using GoToWebinar for over 10 years, and doing these Saturday sessions for over 6 years now. So thank you so much for your ongoing loyalty. We got just a couple of minutes left till today's main broadcast, but we're going to get underway soon. Pardon me while I have a sip of coffee in front of hundreds of people. Have coffee or tea or whatever your favorite beverage is. Adversity demands action, and you need to raise your plateau or raise your standards as a trader and break through plateaus. And strategically, the way to do that is to get specific actionable intel from a real money trader, and myself and others. I learned from a few people out there, but develop your own personal trading plan in a way that makes sense for you on your terms. So we're going to go ahead and get started right here, right now. All right, well, now we start our main official broadcast. I wanted to welcome all of you to today's episode of Trading Week Ahead for Saturday, August the 18th, 2018. I have to look up the date. It's been such a busy week. I hope that y'all are having a spectacular end to your summer. With stock market volatility continuing to be spectacular, it's a great time to trade. The two patterns I've seen consistently lately are a lot of gaps, which are great because that's my number one favorite pattern, and a lot of mean reversion plays. And so be on the lookout for those as you seek to profit from the upcoming market sessions we've got ahead. As always, all information is for educational use only. I'm not making advice about what to buy, sell, or hold, and by watching this, you agree to not make actual trades. Sorry, Earl, I misspelled your name. I can't believe I did that. I'm so busy The late, great Earl Nightingale, wonderful speaking voice. Be sure to get the Essence of Success CDs, or now maybe they're MP3s or whatever. Anyway, our quote of the week comes from Earl Nightingale, who said, "People with goals succeed because they know where they're going." And it's true in trading, isn't it? Because a lot of traders have no clue. You're just kind of blindly throwing darts at the market and you don't have a specific game plan. So start developing actionable tips, kind of like a flow chart or a map or a mind map or a bullet point list of things you check before you put money into a trade. At least that's what I do. Our coaching tip of the week, price action tips part number 2. I want you to focus on the widest range charts in our current markets. And we've got a lot of examples coming right up for you. But I do want you to pay attention to the widest range charts with the largest point range for good potential profitability. Remember, paper trade before you use live money. All right, well, let's take a look at our broad market. Our S&P is currently bouncing up a little bit. The last couple of days we've seen an uptrend day after day. I want you to be careful though, because we're not yet at a new high. So we're not yet at a price. This is a good exit target price. This is a smart, intelligent place to tighten in trailing stops on open swing trades. Day trading's been great. So day trading any of the midweek opens is great. But as swing traders, I want you to tighten in trailing stops for open longs and be cautious until we take out new highs. My official R1 trigger is 28.72. I'm going to be deeply cautious. And the reason is, look at how flat these candles are. And what I call melted candles. We've got bearish upper shadows 3 in a row, and that led to a downtick. We've got a hammer here, so that led to the uptick. But right here is a particularly treacherous place. One of my longtime rules I've trained thousands of people in since the year 1999 is to avoid buying the closing part of a bullish cup, like right here. This is a left side of a cup, came down, hammer support, it's reversing back up, but right there is a sell signal area or a resistance area within which you probably don't want to put on new swing trades. So that's why I'm being conservative and going in earliest at 28.72 to throw new trades or new capital into the market. For the support level, our S1 level is 27.88. And the reason for that is that's right under the 50 SMA. Now you notice, as opposed to earlier during the big run up where I got the long triggers correct for you, now I'm using a bit wider, more conservative support and resistance areas strategically as a trader for the broad market. So I'm going to be careful coming up. Picks of the week. Let's start off with Hertz. A nice gap continuation momentum runner. This is one I've been alerting my members to, and I like the fact that we're up at a new high. Mean reversion gap continuation play. Next up, this is a pick that my small cap scans members got. Office Depot ODP. You can see it gapped up. It continued to run, and it ran all the way from 260 up to 3.25, 330. And again, we don't want to buy the obvious new high. Always be thinking deeply cynically and suspiciously, which you should if you've lost money trading. And we've all had our stop losses, some more than others, but we've all had our share of the pain, the struggle, the agony of defeat. Well, we want the thrill of victory, and one of the ways to get that is to avoid false breakouts. And the way to do that, as I've published numerous times in Stocks and Commodities and Active Trader and Equities.com and my Money Show appearances, is have a buffer above the obvious high, and never ever ever in life buy the immediate breakout above resistance, because that's the dumb money trigger. We're probably all tired of being the dumb money. I've been there, you've been there. It's frustrating. You know, the good news is every successful trader today used to be a sucky trader the first few years they were learning, and I'm no exception to that rule. I used to really do badly over trading just a few magic chart patterns at obvious breakout areas and get stopped out, take big stop losses, and get frustrated. And so if you share my pain, it's a smart idea to instead be on the conservative side. Be careful. Capital's limited. Another great chart that my Swing Scans members got last week with the long trigger 21.8. That was the chart of the week, by the way. If you got my email yesterday, had a really good breakout. Oh, thanks for all the questions. Wow. I probably won't have time to answer a lot of questions, though I will try. We've got a really epic turnout as usual, and got all these questions scrolling by, and I'm trying to follow. I try and pick out a couple of good ones, but I do take time to answer all questions for my members in the members events, but in the interest of time, I'll try and get to a few of them for you guys. Anyway, look at this chart. What does it have in common? One of my favorite chart patterns is a large momentum breakout candle at the right side of a bullish cup or congestion zone. Certain other educators that I won't mention have copied that or borrowed that pattern, and that's okay, I guess. I guess I should be flattered, right? Duplication or imitation is the sincerest form of flattery. But anyway, the point is that's a pattern I've been teaching traders since 1999, for the record. Anyway, it's a nice large candle at the right side of a bullish cup. Somewhere above that high of that candle will often lead to a new breakout continuation, especially if that momentum candle has significant high volume on the gap. Like this guy had 30 million shares plus on the gap day, and it ran from 1940 to 21. So whole number resistance. Continues to look good. Now, in our current mean reversion environment, how many of you agree with me that this may well drop any second and come back down to earth, right? I think it may well. Maybe it runs at 24, whatever. Maybe it stalls and Monday gaps down and it drops down here. But then it may well resume its uptrend. Be ready for that resumption of the uptrend. Or if it does just continue to run on up, be ready for that too. But always be on the lookout to prepare for potential mean reversions. And let me ask your guys' advice. Here's our weekly trail to stop with Ken exercise. I'm long dust in my Fidelity account. I bought it last week. Boom! Nailed it, baby. But I'm a little nervous long, and we can zoom in and see why. My question, you guys, is if you were me, and I'm long dust, and I'm happy about being long in dust, but I'm a little nervous with this pattern. It looks like I don't like the declining highs here, and I certainly don't like the fact that we've got all this kind of bearish cup action going on the last couple of days. Where would you trail a stop if you were me? Where would you get out of dust if you were me? This is the part where you all type in a number. I'm trying to get you to think like an actual trader, like I am. You're always faced with these decisions. Now, I'm not long like 100,000 shares, so I don't really lose any sleep over it. I play the field. I play like my colleague Tom Sosnov, who's brilliant. He's my favorite guy on YouTube to watch and one of the smartest people I know in the whole industry. And his team say trade small, trade often. I agree with that. I trade wide, not deep, same kind of thing. So I'm not going to lose any sleep. Wow, all these answers. I got 27.5. No, 37.5, 38.4, 37.75, 36.50, 37.50, 37.50, 38, 37.5, 37. 9, 37.75, 37.9, 35, 38.81, 38. Exit now. I like that mark. That's smart. No lower than 37.80. I agree with that. And that was Mira. Hey, you always seem to get it exactly right. Congratulations. You're right. 37.80. That'd be the right place. Just under the 38 whole number. That's what I'm going to use. So that's my answer, is a loss of the 38 whole number. And I don't sell the whole number. I use usually 20 cents or so below it. So one of my longtime traders, Mira, got it right. As always, I'm impressed. 37.80 is the right place to put a trailing stop on this long position, right? Now it may gap down here, and that would be another story. It gaps up, and happy times are here again, and we buy in. But right, just under the nearest whole number low, 37.80 would be the place that I'm going to put my sell stop order in. So that's smart. Always think about playing it as tight as you can, kind of like a squeeze play. You're looking at the trade like a logarithmic curve. It runs up in your favor, like in life in general. You know, making your first $1 million is really tough, but it's the person you have to become in order to make the million that's more valuable. But the trick is not just making the first million, it's keeping as much of that as you can and not pissing it away on cars and trips and bling and man cave stuff and all that, though I've done that too. But the point is, when you're in the money in a trade, trail a tight stop and make sure that you get out sooner rather than later. Because in the back of my mind, you know, it's just one of the next 10,000 trades I'm going to do, so I can always rebuy a new high somewhere up here, right? If it does resume its march up. But if it starts to fall off a cliff and goes down here, you're going down, baby. Boom. You want to cash in before the market takes your money back. All right? All right. Let's take a look at our charts here. Who else is... What's going on with oil and gold? Well, dust is up. One thing that I'm mentioning for my Swing Scans members is, and let's put it in context on the 90-day candlestick chart. This has come down so far. It may keep going down to 10 or 6, we don't know, but it's come down so far. This one is Nugget, N-U-G-T. This looks cheap to me. This looks like a good deal to me, so other people may enter. Now on pivots, I learned the hard way. Don't buy a dead cat bounce. Don't catch a falling knife. Ouch. We don't want to do that. So we don't want to buy right now or anything. And I don't want to buy even the first sign of a move, because I'm going to be a skeptic. I'm going to expect the first sign of a move is the market makers are trying to get you all fluffed up, and then they're going to step on the ask and it's going to continue to plummet down to 6 or something. So I'm going to wait till over 15 likely on Nugget. I might go in a little bit earlier, but the point is, ones like Nugget and GDX, these are the long gold miners, right? Or JNUG is another one. Same pattern, right? 6 of one, half a dozen other. Come say, come sa. Más o menos, right? They all look about the same. They all may be worth a pivot, so you may want to be on the lookout for that. Just like my dust may be on the way for a pivot coming down, I want to lock in a gain wherever possible on this guy before it takes it back. Same thing with the inverse plays. We got all these gold instruments like Barrick and Newmont, which I've traded for years. I like the point range though in the miners like Nugget and JNUG. I always want to play the extremes, and I'm not saying to buy these guys because they may well keep plummeting down. So I'm going to wait instead and be a little conservative until there's significant volume on the pivot, right? It's a strategy my longtime colleague Mark Leibovich came up with called the volume reversal, which is very smart. And that's basically if you're looking for a pivot off of a low, it's always smart to have supporting larger volume on the pivot side of the equation. And he's one of the good guys out there. And anyway, that kind of a thinking makes a lot of sense. So you're looking for, if it runs down and it does start to pivot, make sure that you have supporting high volume. Now, if you have, so what I mean specifically is if you have average volume down to say 10 million or less or something, would not be worth a pivot play because the volume is not, I won't say statistically significant, but it's not tradably significant. All right. Does this type of thinking help you guys? I know I kind of run through things pretty quickly, but that's my mind is like a steel trap. And hopefully, I hope I can help you guys develop a trading approach that makes sense, where you're looking at the outlier charts with the biggest point range and the biggest profit and loss potential, and make sure that you're on the profit side of it as our goal and not the loss side of it, right? In our current market, folks, it's really important to trade the outlier charts, the ones with the biggest trading ranges, big, bold, brave, ballsy charts that are actually doing something. See, the doom of traders. I've trained tens of thousands of traders, and you have my word on this. Number one is you guys take stops that are too big, and then number two error is you trade choppy charts that aren't worth trading in the first place. I'll often get traders ask me, what about this chart? And I'll pull up the chart and there's not enough directional volatility to trade it. And so I politely tell the trader that it doesn't have enough range or enough oomph, enough directional momentum to make the trade worth the shot. Because again, as traders, our goal is to buy at a price. It's like buying wholesale, selling retail. You want to buy at a price that's likeliest to attract a wave of new buyers, not just buying a new high. Blindly buying new highs doesn't work. Been there, done that, got the stop losses to prove it. You get false breakouts and all the rest of it. So you've got to trade charts that instead have directional volatility that's so strong and so compelling, it gets people's attention on Wall Street. And they say, okay, here's my money. I think it's going to keep going up. And so those kind of charts are the ones you want to focus your direction and your energy on as a trader. Oh, thanks. Traders saying like the new format. Please keep it up. You're right, from Bob saying, yeah. Robert saying, yeah, you're saying that wait for another high volume to look for, not just the first one. Right. A question from Peter, what minimum percent increase? I don't use a fixed percentage. I'm always a visual guy. I'm looking at the numbers and the math. Visually, I look at the range and the directional strength of the chart pattern, and then numerically I look at the math behind it in terms of the numbers and the point range. So I don't have it's got to be at least 15%. I like on a 15, I will tell you the one thing I do is on a 15-day chart, I like at least a 10% range. Now this has quite a bit more than that, but which is good. But, for example, where's another good chart? Here's one, CGC. The range on this guy is 25 to 34. So I got a 9-point range on a $30 stock, which is well over 10%. So that's the only percent variable that I use, but that's a good smart question. So if it's a $30 stock, the range has to be at least 3 points or preferably even larger, like some of these others that we've covered. The bigger the range, the better. Right? The bigger the range, the better, but with consistency. What's bad is, and what's extremely dangerous, and I urge you to be cautious, is things like the penny stocks or the cheap stocks that'll go 50, 80, 100% in a course of 2 or 3 days, and they collapse back down again. And odds are you're going to be on the wrong side of the trade. And the upfront risk involved in trading cheap stocks is unacceptably high. In my professional estimation and my coaching to the world's traders, I tell you this, it's in all of our best interests. I speak on behalf of the brokers and the charting software companies and all of us who are educators. It's in all of our it's in all of our shared interest for you guys to not lose money and not to blow up and be gone out of the trading industry, because we want to work with each other both on the provider side as well as the patient or the client side. And so one thing that I urge you to do is not trade large size. If you're trading options, you shouldn't be out there doing 6 or 8 contracts. If you're trading Forex, you should not be doing 6 or 8 lots. You should be trading 1 or 2 contracts, 1 or 2 lots. As a stock trader, maybe 100, 200, up to 1,000 shares. But typically you should be on the small side of things. So make sure that you're trading a diverse group of strong instruments with tight stops. That's my number one message for the world's traders. Oil's not doing anything. USO, UCO, oil holders, chopping, grinding, trying to bounce. I don't really care about that. I care about big ballsy charts that have nice big ranges that are actually worth the shot, right? That's what we do. Now for Forex, I didn't see much out there this past week. The Euro CAD's trying to bounce, but I didn't see any of the currency charts that I follow. I'm just doing a quick foray into Forex here. I didn't see any charts making a nice, consistent, 10, 15-day uptrend. I see some recent bounces, and of those, the Euro CAD is the best looking one, but it's still not great. So it still remains a scalper's market in Forex. This is not a time to be swing trading currency pairs. Don't do that. It's a time for scalping, day trading only, which is fine. You may want to trade the various 3 opens and closes or other strategies designed to capitalize on directional volatility. But now is not a time to be swing trading any of the currency charts. You have my word on that. I always tell you guys that this stuff as though you're, friends and family, and you are in many cases. You're friends and colleagues and customers and all that. And I want to try and keep you on the right side of keeping you safe. Just like the Hippocratic Oath is do no harm. My goal is to keep you guys out of harm's way. With all the sharks out there in Wall Street and all the sharks out there in the education community, you guys got to stay safe. Anyway, directional move, CTL, that's a good play. Let's see what else. Oh, thanks. Trader saying taking notes. How about shorting dust? Nah. For an intraday, sure. We'll go long and short dust all day long. Not all day long. During the first half hour, 45 minutes. It had a big directional run up on Thursday, and it gave it all back or a lot of it back, I should say, on Friday. What we're looking for are charts with big open range breakouts. So charts like Harley Davidson did really good. For day traders, I like charts with consistent recent volatility. Another quick tip, I know we're going to wrap up here, but look for charts for intraday swing trading that have a recent history of opening up at one place and closing near the day's high, because that's where the most money could have been made in that kind of a chart. So Harley Davidson is an example of one, right? It's right above the whole number 41, ran into the midpoint resistance of 42.50, buying at 935, 945, selling at 330 or so before the close. Intraday swing trade. Look for those kind of charts that have a open and a close that's higher, and you got a nice directional all day long run that you could have made a lot of money in, and use that as your. That's a lot of how I do scanning on behalf of all of my members. Is I do all that hard work and heavy lifting for you guys and try and figure out these kind of charts for you. But if you're doing this on your own too, give preference to charts or like this one, CGC. Right, it opened up right under 31. Ran all the way to just under 34 for a 3-point run on a $30 stock. Those kind of charts with directional bias or directional volatility all day long are really good candidates for both day and swing trades. So with that, we're going to wrap up. I don't have any big sales pitch or anything. I did want to offer you another free event coming up Wednesday. If you will help me by giving me your honest critique, I streamlined it a little bit based on early feedback from dozens of folks who did it last week. Do this quick one-page survey, and you'll get access to a free webinar coming up Wednesday at 7 o'clock Eastern on gap and breakout intraday trading. And I'll cover some advanced stuff that I haven't covered anywhere else before with current market charts. I don't think I'll have any PowerPoints. I might have an intro slide or something, but I'll just focus on charts like I do. I'm a trader, so I'm not a PowerPoint jockey. I like charts because it's what I trade. And my Interactive Brokers Traders Workstation and my Fidelity Workstation, all that. But the point is, if you would take a look at my live trading room website and tell me what you would improve about it. I always like to ask for good, honest feedback. And if you do that, fill this out. It's only one page. You don't have to, there's no place even to put in your name or email. It's completely anonymous. It's safe and friendly. Fill out a quick one-pager and click the submit button. That will take you to the GoToWebinar link, and you will be eligible to participate in how to day trade winning gaps and breakouts coming up this Wednesday at 7 o'clock. And I'm going to run it 45 minutes, so a nice compress like this session has been, around 45 minutes. So I'll give you my best and brightest based on lots of real money trade experience, and I hope that helps. So again, remember, I'm the $5 million trader, 4.9. It's not quite as catchy, the $4.9 million trader. The $5 million trader, I test out things on, and that was a profitable year. Small profit, but that's because I was testing all kinds of ideas, not because I was trying to make a fortune. I was trying to test on behalf of the business, and the foundation for this is what made the foundation for a lot of my courses and subscription services and the rest of it. So I am the real deal, an authentic trader with tax return proof, and I hope that this helps get you on the right side of things as we get underway. So until next time, trade with passion, trade with tight stops, trade with intelligence, trade with focus, trade with action, play the field. Don't sweat it if any one of your trades doesn't work out. It's just the next to the next 1,000 trades or whatnot. So appreciate all the questions. Unfortunately, I cannot answer all the questions. The survey, it's in the chat box. It's also in my Twitter feed. If you go to twitter.com/Ken Calhoun, I think it's the third tweet down or fourth tweet, there's a link to the survey. But I just posted it in the chat box. But the survey, and I also emailed it out to everybody. So either on my Twitter feed or in the chat box here. Anyway, I've got to run. Take care. Best wishes for success. I hope that you guys do well. There's a lot of opportunity and a lot of volatility out there in the markets. I want you guys to be on the right side of it and do well. So take care and best wishes for success. See you guys next time. And I do appreciate all the questions. Unfortunately, I cannot answer all of them because I got swing scans coming up in 5 minutes. If you're not yet a member of Swing Scans, do join that. Even though you won't be able to, I don't have time to get you into the webinar in 4 minutes, you will get the recording later today as a member. So do join www.swingscans.com and tradingtheopen.com as well if you're a day trader. And I'll see you guys next time. Bye for now.